Welcome to our 2020 tax update. I am joined today by the illustrious, infamous podcaster of the world, Jeremy Dorn, and his faithful sidekick, Linda Ramming. Linda is new, so be gentle. She's not new, clearly, but she's new to the she's new to the webinar. I told her before we started, she was all nervous, and I said, don't worry about it. You're going to be the smartest one on here. So a couple of housekeeping items. We are recording this, so please don't ask any questions that you don't want broadcast over the interwebs. We will have a couple of polls during the presentation, so like your participation in those. And also, if you have questions, please put them into the Q&A chat bot there, and we will get to them. So without further ado, let's get kicked off. There we are. Yes. Okay. So small business challenges with 2020 and year end. So this is our topics. These are our topics for today. We're going to go over a few items from the CARES Act and the executive order. We're going to do a very high-level touch on retirement plans and capital gain loss harvesting. Then we're going to discuss year-end asset purchases. And then we're going to end with a couple of strategies around entity selection and accounting method. And then finally, we're going to discuss tax projections. So we will move forward with payroll tax deferral.
Yes, this is mine, and this is fairly new that I guess the president signed an executive order last month, and it was supposed to start September 1st, where employees can defer their paying their Social Security tax for the rest of the year, but then they have to repay that Social Security in the first 3 months of next year between January and April. It's from everything that we've read, it's basically all in the company. So it's the employer is responsible for collecting the payback, which makes it not very attractive for employers, I don't think, because if you got somebody deferring and they quit, and then who's going to pay that back, and how are you going to get that money? And it's really going to be on the employer to make up that difference. I've had people call me and ask me, well, they're saying that this might be forgiven, and sure, I guess if Congress can come together and make this official, then maybe you don't have to pay it back, but as it's written now, it definitely has to be paid back. So employers are going to get a bigger check now, and then they're going to get double Social Security for the first 3 months of next year, we pay it back, so they're going to get even smaller checks at the beginning of next year. So I don't know that it's really good for anybody or really does anything.
Yeah, and I'd point out that the CARES Act already allowed employers to defer their portion of the FICA for up to 2 years. So from an employer standpoint, I don't think the executive order makes any sense. But I don't know what's going to happen if employees start whining and complaining and asking for it. Are the employers going to feel compelled to or be required to?
Well, and how do you opt in and opt out? I don't know. Right. I don't think there's any guidance on opting in or opting out, or if everybody has to do it, or what, or employee, if they're going to go down to the employee level, whether they want to opt in or opt out. There's just no guidance on it.
So that leads us to our first poll, which is, whoa, wrong. Sorry, hold on, wrong order. 1 second. There we go.
Plays right into the tax deferral.
Yeah. So have you or will you begin deferring payroll taxes under the CARES Act or executive order? Yes, no, or don't know. All right. That's pretty one-sided. We got one that has. All right. Interesting. Okay.
I don't even think a lot of the payroll, like our payroll system software isn't even going to be able to handle it until the 10th or something. So it's not even something you really could have done on September 1st. But
yeah, the record keeping on it just makes my head hurt. All right.
Real.
There's our results. Okay, so let's move on. EIDLs. So the economic injury disaster loans are direct with the SBA. They're still available. They're still funding. The terms are very generous at 30 years at 3.75%. There are some catches. You have to use it for working capital only. You can't relocate your business, which I don't know how many businesses that would actually apply. Technically, you can ask the SBA to relocate, but you can't do it without approval. Although it can't be used to refinance, it can be used to make debt service payments. So if you've already got loans or leases, you can use the money to make the payments, but you can't go pay off the loan with those proceeds. The dividends and owner distributions, you need to be real careful with that because you don't want any of it to appear that it's coming from those proceeds. So you can pay wages, which is fine as long as they're reasonable wages to the owners. But if we're talking about distributions or dividends like an S corporation, you need to have profits to back it up. So EIDLs, they're not forgivable. I've had some people ask that question. They are not like the PPP loans. So I would recommend, applying and seeing what you get approved for and take the loan. If you think you might have a need for it, it's better in my mind to have the money than to not have the money. The interest does accrue, but you don't have to make a payment for a year, and there's no prepayment penalty. So, if a year from now you don't end up needing it, you can pay it back completely, and it costs you 4% in interest, and well, that's deductible for taxes too. So let's go to the Paycheck Protection Program. The triple P, those words that we don't like to say.
Yes.
Okay, forgiveness on the triple P. As you know, the SBA has changed the time period that you can spend the monies on from 8 weeks with a minimum of 75% of the funds being spent on payroll to a 24-week period with a minimum of 60% being spent on payroll. That change has already happened, and I think that will benefit most of us. The SBA has also issued a forgiveness application. However, we're still kind of waiting to see if they will probably be issuing further guidance on the forgiveness, and we're kind of hoping for a blanket forgiveness, maybe all loans under a certain dollar amount to be forgiven. So we're really recommending you kind of wait out at least that 24-week period.
Yeah, let me interrupt you on that. I got some info from a banker over the weekend, and she had said that Senator Langford's office had said that, and I guess I didn't realize this, they had separated them into two different bills in the House and the Senate, and it has passed, but they're different, so they need to be reconciled when they came back. But Langford seemed to think that when they came back later in the month, that was absolutely going to happen.
Oh, nice.
The number that has been kicked around is any loan under 150.
Yeah,
but
I heard the same thing. I heard the same thing last week. I had another client tell me that their banker had told them the same thing, that anything under 150 was probably going to be forgiven without any of the paperwork and stuff.
And I didn't realize this. The SBA has 90 days to get back to the bank with the forgiveness. So the bank submits the application. The SBA has 90 days to respond. So, yeah. Sorry. Go ahead.
So again, just wait it out, I think.
I think that's the best.
For now,
at
least.
Till the end of the month.
Yeah, to the end of September. Hopefully we'll know a lot more then. So once a part of a loan or the whole loan is forgiven, it becomes a grant, and that's where we get into the taxability issue. The SBA originally stated that the grant amounts would not have to be included in taxable income, and they've kept by that. However, they subsequently issued guidance stating that the expenses paid with the grant money are not deductible. Unfortunately, that kind of circles you right back to the grant's taxable.
Yeah.
You don't put the grant money in income, but you also don't get to put the expenses in deductions. So you're kind of back at square one there.
Well, and I can see a lot of businesses getting a surprise on this because, you know, for most companies, you get 2 months of payroll. That's a pretty big bump in your bottom line. So.
Well, yeah, I think it goes back to that, right? So, and they're still talking about changing that back. That like the AICPA and other groups are trying to get them to change that back. I don't know if they will, so we're not planning on that, but
I think your tax planning should assume it will be taxable.
Yeah.
And then hopefully it would be a wonderful development if it turned out not to be.
Yep.
But unfortunately,
yeah,
that's probably how that will roll out.
So I had a question asked about the EIDL loans. Personal guarantees. No, there are no personal guarantees on the EIDL or the PPP. The EIDL will take a security filing, a UCC filing on the assets of the company. The PPP does not. So hopefully that answered our listener's question. Jeremy, talk to us about retirement plans.
Oh, I could talk days, but I will just talk a few minutes. So yeah, coming here towards the end of the year, it's always while we're doing tax projections, for those businesses that are service related, that don't have big deductions for going out and buying new equipment or anything like that, these can be great alternatives for getting some big tax deductions, especially when you look at doing like a 401k and doing some plan design with profit sharing and some other, you can do like it says here, defined benefit plan, which is like we call it a cash balance plan as well. A simple IRA is just another, it's not quite as flexible, but it does allow you to stick some small chunks of money away and save some on some tax without incurring a whole lot of administrative costs or administrative headaches, but it's definitely not as flexible. And then so the 401k for the safe harbor to be in effect for the current year, you've got to get that in place by October 1st if you want to take advantage of that. You can still put it you can put the plan into play in the year, you just can't take advantage of the safe harbor, which allows you to stick the 19.5 away for yourself and then do some profit sharing. And well, you can do a profit sharing only plan if you wanted, but you just don't get the safe harbor. And then if you already have a simple and you want to switch to a 401k, those plans have to be switched at January 1st because you can't have both of those going on in the same year. So you can't have contributions from both of those in the same year. So like I said, with plan design, with profit sharing in different ways, you can get some pretty big tax deductions while putting away money for retirement, which is always a good plan.
And we do have a recorded webinar that you go into depth that we recorded earlier this year. So if you want to learn more, you reach out to Jeremy or you can go listen to his more in-depth discussion on how these differ. I have a question from the audience of what's the max contributions for 401k for 2020? And I'm assuming that means per individual, not like total. But
well, yeah. So there is two maxes, right? So there's a total that you can defer of your own salary, which anybody that's in a 401k plan can defer 19.5 for 2020. And then the match is obviously depending on the company. And then with profit sharing, depending on what your salary is, but there's some other things that you have to get there. But the total that you can contribute within the plan with the profit sharing and everything is like $57,000. That's for an owner. That wouldn't be for like an employee or whatever. But yeah, the 19.5. And then if you're over 50, there's a $6,500 catch up, so you can really stick in 26,000 if you're over 50.
Nice. All right. Oh, also there is, if anybody's really interested in going into the PPP forgiveness, we've got a webinar on that too, but it's, yeah. Ugh. All right. Capital gain and loss harvesting. This is something that I think that most taxpayers don't pay enough attention to at the end of the year, which is basically your capital gains and losses offset each other. If you have a net loss, then you can only take $3,000 per year. Why do you care? Well, a lot of times you've got both unrealized gains and unrealized losses. You don't get to deduct anything. There's no taxable event, income or loss until it's actually sold. So you might have a bunch of winners and you might have a bunch of losers, and you could effectively wash them out and start over and not owe any tax. Where we see historically where we've seen an issue is that you'll have a year where the market's up and people sell their stocks, right? And they've got this huge capital gain. And then the next January, the next spring, the market tanks. And so their portfolio goes back to where it was, but they've got this loss that they can't deduct but $3,000 a year. And so it's always best practices to look at your investment portfolio with your tax planner and see if it makes sense. You want to be very cognizant of what I call rate arbitrage. So cap gains is taxed at a lower rate generally than regular income tax, starting from 0 to 20%. It is included in the net investment income tax. So you have to be careful of that. If you make above a certain amount of money, that 3.8 will kick in. So it's not as simple as looking at your portfolio, looking at the reds and greens and say, but it is definitely something to review. I've got an example here where here are the cost basis and market value. So you've got in this column short-term gains or loss, the reds are losses, and long-term gains or losses. So if he were to liquidate everything that had a profit or a loss on it, he'd have a net loss of approximately $9,000, of which he could only take $3,000. But if he wanted to match up, say, for this, where he's got basically a long-term gain of $5,000 and a loss of $5,000 and a short-term gain of $5,000, he could net those against each other, reset his basis, and no tax consequences. I will say the wash sale rules come into play, so make sure you talk to your tax preparer, tax professional. It's not something you want to try and do at home. Now we're to my favorite discussion. Go ahead.
Asset purchases and depreciation.
Before we do that, I want to launch this poll. Let's ask this question of, where are you? There we go. Do you plan to purchase fixed assets before the end of the year? Yes, no, don't know yet. While they're answering, go ahead, Linda.
I think Jeremy referred to retirement plans as being something he could talk about for a while. I was thinking you could easily do an 8-hour webinar on depreciation and asset purchases. I won't, but you could.
Thank you. We appreciate it.
I will not, but you could. So depreciation, generally speaking, is the allocation method we use to spread the cost of a fixed asset over the useful life of the same asset. So it allows us to depreciate and expense a little portion of it every year. The example on the screen, we've given you 4 columns of different methods of depreciation that are available to you in 2020. And you can see the top one is for an excavator. Second line is for an SUV. Third line is for commercial real estate. The first column you're looking at, that is something called bonus depreciation. Second column is makers. Third column, section 179. The last column is Indian land. Each of these four methods has qualifying terms. The asset has to qualify for that method of depreciation. And again, this is not something you would try to do at home, but you would talk to your tax professional about. You can see on just the excavator alone, you can get anywhere from $20,000 to $100,000 worth of depreciation in this first year based on which of the four methods you select. So
let me ask you a question, Linda. You know, as a business owner, if I paid $100,000 and I can write $100,000 off, why wouldn't I want to do that?
You might want to stretch it out over, it's a 5-year asset. You might want to stretch it over all 5 years. You might need a little bit of that depreciation depending on how well you were doing and your taxable income in year one. Mm-hmm. You might need all $100,000 as a deduction, or you might not need it all, in which case you could spread the remaining dollars over the remaining life.
Yeah, I've seen, and I'm sure you've seen this, I call it the Section 179 trap, where people get into this year-end buying spree and they get rid of a lot of their taxable income, but then business kind of levels off and, well, there's no more equipment to buy and you don't have any more write-offs, and all of a sudden you've got a huge jump in income that you weren't ready for.
Exactly, because you did preload the depreciation. So there's a fine line between how much you want to take in year one versus allowing some of it to be left for your following useful life.
I'm going to share the results real quick before you go on. Split pretty even.
I started to say, wow, it really is.
Okay, go ahead. Sorry.
So that's okay. So there are various, like I said, it has to qualify. The asset you're purchasing has to qualify for one of the four methods. You also have different factors, including bonus is basically 100% for 2020. If you choose bonus depreciation, you're choosing 100% of the cost of the asset. You also have to choose that bonus depreciation for an entire asset class. You can't pick and choose little assets to apply it to. It's by class. You can opt out entirely by class or stay in entirely by class. But either way, you're doing that method for every asset with that 5-year life or 7-year life or whichever life. As compared to Section 179, where you can pick and choose each asset, you can pick and choose a dollar amount on an asset-by-asset basis. So in that way, it's much more flexible than the bonus depreciation, but it does have an annual spending limit on fixed assets. It does have a maximum you can deduct of $1,020,000 a year, and it is limited to taxable income. Bonus depreciation, you could be at a loss and still take bonus depreciation. So.
And the Section 179 is aggregated at the individual level. So if you owned multiple businesses where you were getting Section 179 from various companies, you have to look at the limits individually as well.
As well, absolutely.
So tell me about cost segregation.
So I was just going to say, cost segregation, if you are purchasing any real property, if you are building property, buying property, it has become advantageous to get a cost segregation study done if it is a large enough dollar amount on the real property. What a cost segregation study will do for you is it will strip out what is actually personal property assets versus the true building, so that you can have some of your assets over 7 years or whatever the shorter lifespan is versus the 39-year actual real estate life. So you're going to get a much quicker depreciation on those assets. One problem with it is it can be costly. The study itself can be between $10,000 and $25,000. So it's really only going to be cost beneficial on large, long-lived, large dollar assets. You can do it on a building already put in place, but if you do it that way, you have to go, you get the study, you have to apply for your change in method of accounting. That method can be, the IRS can actually refuse to let you change your method, and now you've wasted quite a bit of money and expense for nothing. We really only recommend it on new assets, either being currently constructed or purchased. And the right dollar amount, it can really be a cost benefit to the bottom line.
Well, and I'll make 2 points. One is it's the initial tax year. So like if you've already got a building that you've put into place in 2020, you can, and you've already occupied it, you can still get that cost segregation study done. The change in accounting method is just in year 2 forward.
Correct. Sorry, yes.
Yes. And the second thing is, this cost segregation is something that's not utilized enough in my mind, because one of the problems when you've got a piece of real estate for a lot of money, your loans usually are on a 15-year amortization on commercial real estate. So you're paying back principal on a 15-year term, but you're only getting a depreciation on 39. So that means you got cash going out the door that you're not getting a deduction for, and that's like the worst case scenario for taxes. So I think most of the time that I've seen it, you probably aren't going to get equivalent to 15 years to match the amortization, but you're going to get it a lot lower than 39. Okay, let's talk entity selection.
Who's that, me?
I don't know. You want to talk about it? I can talk about it. Whatever you want.
I don't remember who was on this one. Yeah, so entity selection, when it comes down to tax planning, can be very crucial. I think the most popular one we see is making a selection to be an S corp. So basically, every company is set up either as a sole proprietor, a C corp partnership, or they start as S corporations. And so, with a sole proprietor, at some point when they start making a good net income, I usually use $50,000. If you have at least $50,000 in net income as a sole proprietor, it's probably time to start looking at that S corp election. And then partnerships, the same thing. I mean, if you have a partnership and they're both general partners and they're both taking on self-employment income through that partnership, then you basically have the same thing, just with a couple of different people. And it probably makes sense at, again, the $50,000 level to look at making that S corp election to save on self-employment tax. C corporations, there's very limited pros in small business for the C corporation. Christian doesn't agree with me.
I'll give you 2 pros. You got 21% tax rate, so that's good, right? I mean,
yeah, but you got 15 to take. You got 15 to take it out, so you're back at 36. So okay. You can tell me that all day, and I'm not going to disagree with you there. I'm just saying, as far as being an S corp versus C corp for a small business owner, there are very limited circumstances where a C corp actually is probably more beneficial than an S corp. I'm not saying there's not situations out there, for sure. I just said they're limited. So I'm glad you just gave me an example that I was able to knock out of the park. Right. So yeah, so you can revoke it. Again, most of this leads to the C corporation gives you the double taxation. That's what Christian was just talking about. So you get the 21% rate, and that's great. But when you're taking out dividends, you're taking them out at 15% or 20%, depending on what your personal tax rate ends up being. And so that right there alone gets you to the 36% bracket. So if you're only in the 25% bracket, it really doesn't make sense to be a C corp for those reasons. There's fringe benefit reasons and other reasons, but I think the most beneficial one is the S corp in this list, and it's all about saving self-employment tax. Is really
well, yeah, and I put self-employment tax down there too, because a lot of times people choose partnerships and want to be taxed as partnerships. You get LLCs, and technically most of those income flow-throughs are subject to SE tax. Not everybody reports them correctly, but partnerships are best when you have complicated capital structures, or if you want to share income and expenses differently than your ownership percentages. Partnerships are really good for what they do, but it's a narrow use as opposed to an S corporation.
They're good for passive income too, like rental income as well.
Right. Well, and the other thing with an S corporation and a partnership is you have the qualified business income deduction on the flow through the 20% that came in through the TCJA, but that's not available for a C corp. So another reason. I put two subsequent changes down there just to highlight them. Partnership to corporation is not an issue. You can do that. It's easy breezy. It's a taxable event to turn a corporation into a partnership. So just make sure you have conversations with your professional before you make any changes. Accounting methods, everybody's most exciting subject, I know. So there are different methods that you can use on how you account for things. One of the most common is the cash versus accrual. Most small businesses we see are cash-based taxpayers, and for most of them it makes sense. Some businesses, however, depending upon their model, it might make more sense to be on an accrual basis. It's something to revisit periodically, but it needs to be thought of in context of multiple years. It's not something to look at and say, oh, I'm going to get a quick fix this year, because it's a change that has to stay in place for multiple years. You have some automatic selections that the IRS, you still have to fill out a form and say you're doing it, but they automatically approve it. Others, you have to get their approval before you make that change. Linda already discussed depreciation. That's one of them. Inventory, does anybody use inventory anymore? Does anybody have any inventory in this digital age? I know they do. But there are multiple options there, right? Inventory and accounting methods are really worth the squeeze for the juice of seeing if they can save you taxes. So this is not a primer on accounting methods. It's just know what to go talk to your professional about. Any other thoughts on accounting methods, Linda? Yes. Okay. Jeremy, before we do this, I'm going to ask another poll. I didn't share the results of the last poll. Sorry.
Yeah, you did.
You did.
There.
You did.
Yeah, I did? Okay, good. All right. Let me give you the next poll. I expect my income taxes to be more or less about the same. No idea. It is September, not everybody's thinking about it. Not everybody's filed their taxes for this year. So, Jeremy, go ahead while they're voting.
Yeah, so, well, I can't see the numbers because this poll, can I close this? Oh,
there.
Yes, okay, there we go. So going back to the entity, this leads right into my entity structure, and doing a tax projection, which that's all we do here in the third quarter here at CORE. So I'm in the thick of it right now, and I just did this one for a client that in 2019, we decided to make an S Corp election for a couple of companies that they had to start in 2020. And you can see right here in 2020, his income's obviously gone up. But if you look at the line on self-employment taxes, that's the big kicker, right? So if we didn't make the S Corp elections for those companies, the two companies that he's been a part of, no, self-employment tax, go down.
Okay, let me go down here.
There you go, self-employment tax. So in 2020, he's going to pay no self-employment tax on his tax return. And if we would have reported them as the general partners that they were the prior year, he'd have almost $27,000 worth of self-employment tax. Now, he is taking salaries through those companies, so he is paying self-employment tax through Social Security, Medicare, through a wage, but I guarantee you it's not 27.5. So, but I can't show that through our system. That's not. This is on a tax return. So, so yeah, basically it shows right here. I've almost saved him $27,000.
Nice.
That's corp election.
Very nice.
He's excited about that as well.
I'd be excited.
Yeah. So so this right here, this is something that we put in front of clients in the third quarter, starting. I started them back in August, maybe in late July, and so that people are getting kind of sense of how their year's going, where it might go, and what that's going to mean for them tax-wise. So rather than him showing up, next April and doing his tax return and saying, "Hey, you owe $15,000." Well, with state, he's going to owe $22,000. You owe $22,000. Have fun with that. Wow, less than 2019, huh?
Well, that doesn't surprise me. It's been a crappy year.
COVID hit, so
Yeah.
And only one says no idea, so that's good. That makes me happy. I don't like it when there are surprises.
Well, but we don't know if they're going to get all those other people might be getting surprises if they really don't know. But
True.
That's why we do tax projections here. And so then the next one is to really show the importance of planning. I have a client that I just did this tax projection for, and his income has gone up by 7 times.
A lot.
So almost 7 times. He actually pivoted during COVID and started doing something with masks and whatnot, and has just been obviously destroying it. Made some really good contacts, and so you look at last year, and I just went over this with him, and I was telling him his total tax that he's projected to pay this year in 2020 is more than his total adjusted gross income from 2019, and he was just floored. And so now he knows, he's obviously, well, not obviously, people love to spend money, but this guy, he knows not to go spend all of his money. So he's got money in the bank to cover the taxes, but now he's kind of got a better picture of what it's actually going to look like making so much more money this year. So now I can sit in front of him and say, yeah, right now it's about $84,000. And then we just continually update these as the months come in, because he's got a slower end of year. And so we'll just continue to update this and let him know of any big changes that might be coming down. Especially with PPP, because part of this is PPP money too. So
I can't tell you how many times I've seen business owners get stuck with a tax bill that they weren't expecting and had already spent the money, right? Yeah. So they made money. They hadn't owed taxes in the prior years, so they weren't planning on it, and weren't working with us and didn't have a projection. And really, but if I'm sitting here as a business owner and I've made $500,000 this year, and I know, okay, well, I set aside my $84,000 for taxes, I can move forward and do what I need to do. I don't need to guess on what I'm going to need 6 months from now.
Well, I had a guy last year that we did a tax projection for, and he had been setting aside all this money, not spending it on marketing, not doing anything, setting all this money aside for taxes. And when I put this in front of him, it was his first year, and he was like, oh, I don't owe that much? And he's like, well, great, because I wanted to go spend this $25,000 on marketing, but I wasn't doing it because I was so terrified that my taxes were going to come and I was just going to get smacked with taxes, that it freed him up to go spend that money because he knew he wasn't going to get hit with this big giant tax surprise.
Yep.
So.
All right. So few minutes left here for Q&A. Any last thoughts, Linda? We'll start with you. No last thoughts.
No last thoughts.
Okay.
I think you guys did fabulous. That's
Jeremy,
it.
You got any last thoughts to leave us with?
Well, I did have one thought while we were talking about the Section 179 trap that you talked about, which I don't think gets enough credit sometimes, because you take the Section 179 that year and then you finance it, and it makes it even worse, because then you're paying off, all this money's coming out, and then you're making money, not getting the depreciation expense in the next few years. And now you're having income and you have no money because you're paying off your Section 179 from the first year. And so if you're really not growing and don't need that equipment, it can be a really terrible idea to just continually write off cars and equipment and everything else. I mean, it totally depends on your business cycle. If you are growing, it can be a great tool, but like Christian said, if you're plateaued, it might not make a whole lot of sense.
Yeah, if you're a tax professional, their tax advice is go buy equipment. That's what they tell you. Run away, because that's not a good answer. It will catch up with you.
You will just buy a truck every year.
Yeah,
it's
just
a terrible idea.
No. All right, we don't have any additional questions, so I will wrap it up. Tell you guys thank you for your participation. We always wave until the camera is off. Bye-bye, everybody.